Hey there, can I have your attention please? Before we begin, I would like to thank to all of you, especially to those who click like, comment and share for the first part of the video series brought to you by Trendemy. Keep on coming, will you? Have you ever wondered how do traders and investors research stocks using charts? Do you feel that it's too challenging and very technical for you as a beginner? Are you overwhelmed with the crazy amount of information on stock charts that you don't know where to begin? Have you ever dreamed to make money by trading online but you can't figure out on your own? Do you need help? Do you need guidance from an expert, experienced trader? Now, imagine this. When you discover an interesting stock, you can quickly access and study the price movements of the charts like a pro. You can make conclusions and give opinions on the health of the stock seamlessly. Imagine, at the snap of your finger, you can diagnose every single stock, ETF, market indices without breaking a sweat. What if you can sift through all the information, or in my term, noises in the stock chart in a systematic way without stressing yourself? Won't that be great? And look this way. What if you can make money easily because you have all the basic fundamentals of chart reading at the tip of your finger? Will you be excited to know that help is here for you, like right now? Yes? Good. Let's continue. Hey, welcome back. My name is Rafael Canslita. By reading this, I suppose you're looking for ways to improve your trading skills and techniques. More importantly, you're looking to achieve financial freedom from your trades. So, great news for you! You hit the jackpot. This is where you want to be because you'll be learning from me, who has a profitable trading system that beats S&P 500 and Nasdaq year after year. Keep watching. Do you know my interest in trading began as far back as my childhood when I was watching my parents dabble in stocks and got fascinated by the colorful numbers on the screen. I decided to learn to fuel my passion further and started reading books and speaking with friends. I read up desperately on books from Robert Kiyosaki and I thought I'd be able to begin trading like a pro. Well, you see, my friend, I was wrong. I lost all my savings while trading. For your info only, the thing no one tells you about self-help books is that the information may work, but not necessarily for you. So, in order to figure out what truly went wrong, in my case, I compiled a list of all the reasons for my failed trades, and based on that, I sorted out on a trading methodology system for the next 5 years. Well, as I found out, the journey wasn't pretty. I was going around in circles, not getting anywhere with my methodology. However, I didn't give up. I studied the biographies and techniques of great traders. After 4 years of hustling intensely, I now have a trading system that outprofits even S&P 500 and Nasdaq annually. Thank God the hard work and persistence paid off bountifully. I was able to be disciplined and reactive in my trading. I was making single digit followed by double digit and now triple digit profits is a common thing for me nowadays. So boy, you are so lucky. In the next segment, I shall share with you 3 secret things to begin money in stock market. Hey, here's a hint. In order to be a great money making machine in stock market, you must start with basics. So guys, here it is. Hey, sorry to spoil the mood here. Before we begin, it's important that I dice the top objections raised by you in the earlier comments and feedbacks. When you're beginning as an investor, the investing jungle holds the same danger for all of us. But most of the danger lies in the fact that what you don't know can hurt you. Ultimately, you have to know that there are a lot of people looking to take a piece of your wealth. For your info, Many of the awesome members here brought up excellent questions with regards to stock trading. In fact, many of these questions are similar to the ones I had when I first began about a decade ago. Without further ado, let's shatter these doubts and that can misguide you and more importantly uncover the truths that will finally set you financially free. So the first question, is trading risky? Well, my friend, everything in life comes with certain amount of risk and it is your job to minimize it. Similar to learning how to drive for the first time, you are at risk to others. However, after 30 driving lessons, well, that's for me, with an instructor to teach you, you shall be proficient to drive a car. This no longer makes you a danger to others. Likewise, after learning how to trade, you know your entry, exit, and risk. Your trading account is no longer a ticking time bomb. So, where does risk come from? It comes from a lack of preparation and knowledge. If you put in the hard work to learn how to trade just like any other things, risk can be reduced to a comfortable level. So now, how about the second question? Do you need an MBA or college education to trade stocks? Listening to all the financial mumbo jumbo on TV makes people think that they need an advanced degree in finance to know what's going on. Nothing could be further from the truth. Typically, the more financial schooling the person has, the less effective they are as a trader. Why? Because traditionally, financial education does not teach people how to make money through trading. It teaches them to be good employee. So what education is required? Books, CDs, seminars, and online courses. In fact, it does not require any formal college classes, in my opinion. Next question. Stock trading requires you to sit in front of your computer whole day? Well, this is absolutely not true and I feel it's unnecessary. It uses up too much of our time and does not produce positive results. So why do people still do it? Perhaps they feel like they should be working. The interesting thing is that stock trading does not require a lot of work. It takes time, effort, and diligence to become proficient, of course, but the actual trading does not take a lot of time. Sitting in front of computer all day usually causes people to overtrade. This means that the more time a person spends at a computer, the more trading they tend to do. It happens because we get more bored and feel like we should do something about it. If we want to be successful traders, it's important to make our decision based on what's going to make us the most money. And that means we must refrain from using stock trading to entertain us or make us feel like we are working hard. And the last question, stock trading requires analytical intelligence? Some people think that you have to be a mathematical expert to be a successful trader. Well, nothing could be further from the truth. It only requires elementary school math to understand the mathematical aspects of stock trading. The challenge is that many people who hate numbers are put off by stock charts and price. Finding a good introductory course to learn these basics will quickly overcome this challenge. So, I hope I've addressed the four top objections from all of you. Okay, so thanks. Alrighty friends, for the first educational segment, I shall cover on moving average in further detail. As you can remember, in the earlier first video, part 1 series, moving averages are without a doubt the most popular trading tool and indicators. Moving averages are a great tool if you know how to use them. But you see, most traders, however, make some fatal mistakes when it comes to trading with moving averages. I'm going to show you how and what you need to know when it comes to choosing the type and the length of the perfect moving average and ways to use moving average when making trading decisions. Okay, the first 3 points that I will share in a moment will be as follow: EMA versus SMA, exponential MA versus simple moving average. Which indicator is deemed the best moving average? Next is which time frame shall I use for moving average to read charts? And finally, how to apply MA, moving average indicators, in assessing stock charts. In the following chart, it shows a price movement with two different moving average, namely exponential moving average, which is red in color, right? And a simple moving average. Okay, this is blue. Okay, simple moving average SMA is calculated by adding the prices for a specific time period followed by dividing the total by the number of days. So basically it means, let's say you have 1 plus 2 plus 3 divided by the number of digits altogether. So it's divided by 3. So you get 1 plus 2 plus 3 is equal to 6 divided by 3 is 2, right? That is simple moving average. EMA seems to be following closer to the price action as compared to SMA. This moving average is preferred by the day traders, okay, as a tool for buying or selling stock. If you notice, EMA again assign greater weight to the most recent data. You can see that for SMA, it actually reacts lower as compared to the EMA, the one in red. Okay, let's take a look at what's the difference between, what's the advantages between SMA, simple moving average, and EMA. For simple moving average, the advantage is that it reduces noise associated with fluctuating rate, making it easier to identify trends and trend reversal. Right? And however, the disadvantage is that it is slow to react to latest rates, so buying and selling signals tends to lag further behind in the market. Okay, what about EMA? Okay, EMA more appropriate for a fast-moving, ranging market and makes it easier to see the effect of more recent rates. However, this is more likely to send a false trade signal. Let's say if you're a day trader, right? So we move on to the next slide. So some of you might be asking, what is the best time frame? Okay, after choosing the type of your moving average, traders ask themselves which time frame is the right one that gives them the best signal. Well, there are two parts to these answers. First, you have to choose whether you are a swing trader or day trader or position trader. Next, you have to be clear about the purpose and why you are using moving averages in the first place. Let's go about this now. Okay, number one, when you're a short-term trader, right, you need a moving average that is fast and reacts to price changes immediately. That's why it's usually best for day traders to stick with a 10 simple moving average. Okay, sorry, 10 moving average. Why? Because in the first place, right, it's very popular and it moves quite fast. Okay, this is a 10 moving average, the blue line, right, in this chart. Okay, what about a swing trader? Okay, swing trader have a very different approach and they typically trade on the higher time frames and also hold trades for longer periods of time. Okay, this is swing trade, red color. All right. Besides holding it on the higher time frames, these swing traders also pick the SMA as their choice, simple moving average as their choice, and also use longer period moving average to avoid noise and premature signals. Okay, in this case, I use a 50 moving average, simple moving average, um, as a standard. Okay, why? For swing traders, they like to use 50 moving average because aside from being very popular, they use it to ride trends. Okay, some of them are trend followers because it's the most ideal compromise between too short and long term. And finally, the green line, Okay, this is usually adopted by the position traders. A position trader is a type of stock trader who holds a position for the longest term. Okay, you're not talking just about months, sometimes it can stretch to years. Okay, long-term traders are not concerned with a short-term fluctuations, basically market noises that you hear every day on CNBC or Fox News. Okay, because they believe that their long-term investment horizons will smooth this out. Hence, 200 moving average is usually adopted by them for transaction. Okay, here's a bonus. All right, if um, you have to stick to the most commonly used moving average to get the best result. Okay, moving average tends to work when a lot of traders use and act on their signals. Thus, go with the crowd and only use the popular moving average. So usually the popular moving average, like what I said again, is usually 10, 50, 200. Some of them they will use 21 and 100 as well. Okay, but then basically it's just these few numbers, right? Well, what about me? Basically for me, I would use 50 and 200 moving average, and it works well for me. And in fact, I actually experience a lot of double and triple digit profits, okay, from this period setting, right? Next, I'm going to show you about how to use moving average. Okay, I'm going to use the first example, okay, in trend direction. Okay, now that you know the differences of the moving average and how to choose the right period setting, we can take a look at the two ways moving average can be used to help you find trades, and then you write the trends and exit the trades in a reliable way. Okay, in the chart here, I marked golden cross and death cross. Okay, golden cross I put it as GC and death cross as DC. Okay, these are the entries and exits. Basically, you would enter short term when the 50-day, okay, this is your 50-day again. Okay, take note, 50-day moving average crosses. Okay, sorry, you will enter short meaning you when the 50 moving average plunges or crosses below the 200 moving average, and you will buy when the 200, okay, is being crossed by the 50 moving average. Okay, I say again, basically you will sell short, okay, when the 50-day moving average pierces below the 200 moving average, and you will go long when the 50 moving average pierces above the 200-day. Okay, although the screenshot only shows a limited amount of time, you can actually see that the moving average crossovers can help your analysis and pick the right market direction. Okay, some of you might don't understand earlier what I've explained. Okay, basically death cross, like what you see here. Okay, you see the 50 moving average crosses below the 200. Mind you, this 50 moving average is your medium trend. Okay, then it's a long term. When this thing pierces down, it just indicates that the market, okay, is going through some correction, and it's advisable not to dwell in trading, especially if you're a novice. All right, what about this GC? Golden cross is basically when the 50 moving average crosses the long-term trend 200 moving average. Usually this signifies that the market is very bullish, and this is a time to actually ride and make profits as much as possible. Okay, for the second thing the moving average can help you with is support and resistance trading, and also stop placement. Okay, because of the self-fulfilling prophecy we talked about earlier, you can often see that the popular moving average work perfectly as support and resistance level. But here's a word of caution, alright? Moving average don't work during sideways market. When price ranges back and forth between support and resistance, the moving average is usually somewhere in the middle of that range, and the price doesn't respect it that much. Okay. However, moving average should only be used during trending market. Okay, in this chart, it shows a price chart showing a price chart with a 50 and a 200 period moving average. Okay, 50 and 200. You can see that during the range, moving average lose their validity completely. But as soon as the price starts trending and swinging, they are perfectly act as a support and resistance again. Okay, this is what I mean by that. All right, this is quite sideways, especially this one here. Okay, it's as good as not using the moving average. You will only want to use a moving average, let's say, because I use a 50 period moving average as for my trading. I'll prefer to see this moving average either uptrend or downtrend. In this case, yes, I will consider to buy some here and perhaps some here. All right. Okay, moving average can also be used as a stop placement. Moving average a great tool when it comes to stop trailing and protecting your trades. During trends, moving average work as support and moving average. So another tip from me, never place your stop directly at the moving average. Always give it some room to avoid stop runs. Okay, what it means by that is that don't, let's say if it plunges here, don't quickly sell it over here, alright? Maybe you just sell it maybe here or a bit of here. Yes, I know the loss can be quite emotionally hurtful, but this is trading, alright? Same thing. You wouldn't want to buy as soon as it crosses here. You want to buy a bit with some buffer here. Okay, this is where you buy, right? So the length of the period of moving average determines how long you will stay in the trade. A shorter moving average gets you out of trade sooner, but a longer moving average avoids many of the false signals. Right? There's no right or wrong. Okay, it's just a personal choice. Okay, like for me, sometimes I would use a 200 period moving average. Why do I say that? You see, let's use this for example here. Sometimes when I buy around here, it will go up, the price will go up, and then it plunges, maybe for some news, maybe the CEO resigns or there's a poor earning report. However, over time you see that the 200 period moving average goes up, okay, and it actually slashes around here, somewhere here. But take note, I bought it here and I sold it somewhere around here. Yeah, the profit is there, it's not too shabby, but that's what I mean by profiting um, when there's an uptrend. Okay, before we move on to the next segment of the presentation, all right, let's recap what you just learned. You learned that moving average are a multifaceted tool that can be used in a variety of different ways. Once a trader understands the implications of EME and SME, the importance of the self-fulfilling prophecy, and how to pick the right period setting, moving average becomes an important tool in traders' toolbox, right? Okay, we move on to the next part, which is the chart pattern. Okay, some of you might be wondering, why am I using this picture? Well, God knows why. I'm a big believer in chart patterns, and there are a few that can produce very reliable signals. However, it's never about the patterns themselves, but what those chart patterns tell you about the market dynamics and how trader move the prices. I'm going to show you how to decode any chart pattern so that you will be able to understand price movement in a much better way. We will take a look at the top 2 chart patterns and how you can use them to make better trading decisions. Okay, all chart patterns that you may have here, such as head and shoulders, triangles, wedges, pennants, cup with handle, are primarily made up of 3 components. If you understand how to read those 3 components, you can make much better trading decisions and understand price in a new way. Okay, I'm going to cover on high and lows, length and steepness of trend waves, and depth of pullbacks. Okay, these are the 3 main parts of chart pattern. Okay, although it sounds very basic, the analysis of how high and lows shape on your chart builds the foundation of any chart pattern analysis. We shall get into the nitty-gritty soon, but all future chart analysis is based on the understanding of highs and lows. Okay, on the left, it shows that the higher highs is going higher, and the higher lows, the highs is going higher and the lows is also getting higher. Okay, this signifies a healthy uptrend, while on the right hand side it shows that the highs is getting lower and the low is getting even lower. Okay, this signifies that the market is not really that strong, and is experiencing a downtrend. Okay, uptrend, downtrend on the right side. The strength of a trend is defined by the individual trend waves that exist between the highs and lows. Here, you should specifically look at the length, size, and the steepness of those individual trend waves to get a feeling for trend strength. Most conventional chart analysis only focus on the highs and lows, but an important part is understanding what happens between the highs and lows. The image shows the first trend wave on your left, which is steep and long. The second wave was steeper and shorter in duration. And finally, the third and the fourth trend waves are steeper than the first two. Okay, you can see that it's getting steeper and steeper, the gradient of this trend. Okay, next we're going to talk about the depth of the pullbacks. Alright, once you have identified that price is in a trend, the pullbacks within that trend can provide valuable information of what might happen next. Okay, the screenshot shows an uptrend with many consolidation and retracement in between. However, just before price reverses into downtrend, the final retracement is much larger in size and duration, showing that something had changed in the buyer-seller sentiment and balance. Okay. Usually, chart patterns are not that clear and far from the textbook examples that you will usually find in trading literature or other trading websites. Thus, it is even more important to understand how to decode chart patterns to make the right trading decision. So guys, let's take a look at the two most commonly traded and discussed chart patterns and see how our three principles apply to each one of them. Okay, the cup with handle pattern is a series of highs and lows. The pattern shows a slow transition from a downtrend into a new uptrend. First, you see a series of lower lows, followed by a consolidation at the bottom of the cup, and finally the price starts making higher highs. When the price breaks the top of the cup, the uptrend is confirmed. Okay, a double bottom is the end formation in a declining market. The pattern is formed by two price minima, okay, these two, separated by the local peak defining the neckline. The formation is completed and confirmed when the price rises above the neck, okay, here, indicating that further price rise is imminent or highly likely. Okay guys, so let's recap what you've learned. As you can see, you can understand and decide all major chart patterns by looking at how high and lows form, how steep and long trend waves are, and how deep retracement are. This knowledge also enables you to estimate the quality of the chart patterns and how it will improve your chart reading abilities as well. So moments ago you discovered that high and low build the foundation of all chart analysis. The first shift in sentiments occurs once price stops making higher highs and lower lows. The length and steepness of trend waves define the overall trend strength. And finally, the depth of retracement in between trend waves tells you a lot about the balance between buyers and sellers. Okay guys and girls, this brings us to the last segment of this video series brought to you by Trendomy. I hope you guys are still here with me because I have something so exciting to share with you in the next two slides. So what is it I'm going to share with you? Before that, imagine how do these professional traders earn profits year after year more than 20%. So that's why I'm going to share with you in the next video series how the great trend followers win fortunes in the markets, and what tips and directions trend followers offer so you can learn to invest as they do. You will also learn how to discover the 200-year-old ancient secret to profitable trading, so powerful that all the top traders have sneakily used it to their advantage, and many more. This brings us to the last part of this video. Okay, I'd love to hear what you have to say. Please click like, share, and comment in the comment section below. Okay, because I love to hear your feedback on how to make this video series much more engaging, entertaining, and lastly, valuable, so that you will learn something. Okay, with that, I sign out, and I'll see you in the next video series.